Ian Wyatt has shared his insights on 5 hidden AI stocks with the potential for a massive 1,355% gain. In this video, I'll break down each of these stocks based on the clues he left in his presentation, saving you thousands by doing the research for you. There's no paid or proprietary information here. Everything is based on clues and publicly available presentations. Let's jump straight into things. All the stocks Ian has identified are related to nuclear energy, with the premise that AI's growing energy demands will drive the expansion of the nuclear sector. First up, Ian claims that nuclear power will grow due to increasing energy demands from AI. Here are the clues left for us for the first stock. Ian says this will quickly become the #1 uranium stock. It just began production last August. The US government just agreed to a $30 million purchase. Plus, the company has reserves valued at over $22 billion. Shares of this $7 stock could quickly jump 393%. Based on these clues, it seems the stock being teased is Uranium Energy Corp. The ticker symbol is UEC. Here are the stocks. First, the stock is overbought and overhyped. UEC has been called one of the most overbought names in the uranium sector, which means its price has surged far quicker than its fundamentals can justify. Once the hype fades, we could see a sharp decline in its stock price. Second, the company isn't profitable yet. In fact, it posted a net loss of $19.7 million in the last quarter with zero revenue from uranium sales. With no cash flow from production, this is more of a speculative play than a solid investment, and that's a risky bet. Third, the stock's growth is too dependent on uranium prices. With the company unhedged, their future is tied to market fluctuations. If uranium prices, which peaked at $106, drop further, it could dramatically affect their growth. Fourth, production delays could pose problems. Although they've restarted production in Wyoming and are preparing for South Texas in 2025, mining is a complex process, and delays could derail their plans. If they don't execute properly, those lofty production goals could turn into costly setbacks. Finally, there are geopolitical risks. With global tensions, especially related to Russia's uranium exports, UEC's strategy focusing on US-based supply chains may not shield it from disruptions. Next up is the second stock, a small modular reactor or SMR maker called Oklo. The ticker symbol is Oklo. The founder of ChatGPT knows that AI requires huge amounts of electricity. That's why he invested in this next-generation energy startup. After investing more than $300 million, the stock just IPO'd. Grab shares today before it jumps 389%. Oklo is a borderline buy, and here is why. First, regulatory hurdles could delay their progress. While Oklo has made strides with the U.S. Nuclear Regulatory Commission, the approval process for new nuclear technologies is a long and challenging journey. One delay could jeopardize their momentum, making this a risky bet. Second, Oklo has a strong financial position with more than $288 million in cash and minimal debt, providing them with the resources to continue their development. However, they are still spending more than they are earning, and will need to demonstrate they can grow profitably. Third, Oklo's technology has the potential to revolutionize energy generation by using recycled nuclear waste to produce clean, affordable energy. While this idea aligns with the global push for sustainability, the company won't have a reactor online until 2027, meaning investors will need patience. Fourth, the involvement of Sam Altman, the chairman of OpenAI, adds significant star power to the company. But even with strong backing, hype can fade, and it doesn't guarantee profits. Fifth, the company is gaining from the resurgence of nuclear energy, with major tech firms like Google and Amazon investing in small modular reactors for their data centers. While Oklo's innovative reactors have the potential to be transformative, it is still in the early stages and has not yet earned any revenue. Let's move on to the third stock. Ian highlights that the U.S. government has given just one company a virtual monopoly with a $150 million contract. This single company is allowed to provide next-generation fuel for the Oppenheimer project. Shares of this stock could easily double or triple in the next year. The stock being referenced is Centrus. The ticker symbol is LEU. However, this stock has some challenges. First, while Centrus has a significant cash pile from recent convertible notes, they still carry no net debt but plan to spend heavily on expansion. Investors may question whether that cash will be spent wisely. Second, Centrus is extremely volatile. The stock has seen massive swings, making it difficult to predict and harder to stomach for conservative investors. Third, Centrus is overly reliant on uranium demand. While the nuclear renaissance sounds promising, Centrus's fortunes are tied to the uranium market, which could experience a downturn if demand doesn't meet expectations. Fourth, there's a risk that government funding may dry up. Centrus relies heavily on U.S. Department of Energy contracts, but with new executive orders potentially halting funding, this crucial lifeline could be at risk, which could destabilize the company. Fifth, Centrus's profits are inconsistent. They posted $73.2 million in net income in 2024, down from $84.4 million the previous year, showing mixed earnings that raise concerns about its long-term stability. Ian says this about his fourth stock: "This is the only company approved to build a next-generation Oppenheimer project. A new contract means they could build over 24 of these plants that can be connected directly to AI data centers. Grab shares today before they take off. My estimates suggest 426% upside potential. The company in question is NewScale. Ticker symbol is SMR. NewScale is a borderline buy, like Oklo, and here's why. First, execution will be key, and the company has had stumbles in the past. The stock has soared over 700% in the past year, trading at 163 times forward sales, which indicates that the growth potential is already baked in. If NewScale doesn't deliver by 2029, the stock could take a massive hit. Second, the company holds a first-mover advantage in the small modular reactor market, being the only one with a US-approved SMR design. Once their updated 77-megawatt design is approved in mid-2025, they could dominate this emerging market. Third, NewScale has big partnerships, including a $900 million pledge from the U.S. Department of Energy and deals in countries like Ghana and Romania, which could lead to contracts and cash flow in the future. Fourth, while revenue growth is happening, NewScale's revenue jumped 62% to $37 million in 2024, they're still burning cash and posting losses. The stock is more of a growth play than a profit play at this moment. Finally, the fifth stock is Denison Mines. The ticker symbol is DNN, a small Canadian company that has staked over 700,000 acres near the world's largest uranium mine. Here's what Ian says about it. One tiny Canadian stock has staked over 700,000 acres right next door to the #1 mine in the world. They're sitting on 250 million pounds of uranium worth over $2 billion. That suggests the stock could be worth 135% more than the current price. First, the company's cash burn rate is high. Denison is relying on stock sales to fund its projects, and this constant dilution could negatively impact the share price if investors lose patience. Second, the company holds 250 million pounds of uranium worth over $2 billion, which suggests its stock could rise by 135%. Denison Mines is recommended for several reasons. However, they aren't producing uranium yet. Their Wheeler River project won't even start until 2024 at the earliest, meaning no revenue for the time being. Third, there's significant execution risk. Denison is counting on its mines being low-cost producers, but mining is tricky, and delays, cost overruns, or underperformance could derail those projections. Fourth, the project's timeline is long, with the first mine not expected until 2024 and the second mine not until 2030. For those looking for quick gains, Denison is a long-term play that may not provide immediate returns. With all these risks, Denison doesn't look like a worthwhile investment at this time. There are some exciting opportunities in the nuclear energy space, but as with all investments, the risks are significant. Be sure to carefully consider the challenges and timelines of these stocks before making a decision. Now, if you found this video valuable and you want to diversify your investments beyond traditional stocks and bonds, I have just the thing for you. Even though I believe that investing in a low-cost index fund is the best long-term investment for the average Joe, the benefits of solid physical gold are hard to deny. I think of physical gold as insurance against unpredictable times, and I'm not the only one. In 2023, central banks added over 1,000 tons of gold to their reserves, the second highest annual purchase in American history. And in 2024, central bank got another 290 tons of gold in just the first 3 months of the year. If the biggest banks in the world are buying tons of gold, I'm sure there's a good reason for it. I found a company that allows ordinary Americans to own and securely store physical bars of gold as part of their IRA account. The best part is that they're giving away a free guide to teach you all about investing in solid physical gold. If you want to learn more about how gold can protect your retirement savings, just click the link in the description to receive a completely free gold IRA guide.